The ECB cut rates again today as European officials are beginning to realize that consumer prices over the last couple of years actually hid the Eurozone's and the global economy's lack of recovery from 2020. That's why interest rates continue to fall and fall rapidly all over the world. In Germany, the 2-year 10-year spread finally uninverted for the first time this week as 2-year rates have absolutely plunged. These are not good signs. Rate cuts are not stimulus. They are policymakers figuring out what's really going on. And Europe is a perfect example of why recession matters in the US. A US soft landing would have meant that Europe's woes are Europe's woes. Something wrong and a lot of something's wrong with specifically the European economy. But with the US heading down the globally synchronized path too, what that means is we're instead talking about something far more profound. About everyone not being able to escape the early 2020s without paying the full price. Real wages in the US and most of Europe still haven't recovered their pre-2020 levels yet, and with everything going on the way it has, consumers and businesses know the chances of clawing back that lost purchasing power and income power are sinking as fast as global interest rates are. It was all just a nominal illusion, and you only need to ask Volkswagen, which we're going to do in just a second here. That's what bond yields that have wanted to go lower all over the world have been trying to tell you this entire time. Now that they're crashing almost everywhere, US Treasuries, Europe, Chinese rates just hit more record lows today. Now that rates are falling rapidly, they're saying our time is up. The price illusion of the early 2020s is finally wearing off. And what's being revealed, what's left over, is what we're seeing in Europe. Prices were never the economy. As I said, let's just ask Volkswagen. Let's ask all of Europe's car makers. Nearly a third of major passenger car plants from Europe's 5 largest automakers, BMW, Mercedes-Benz, Stellantis, Renault, and VW, were underutilized last year, producing fewer than half the vehicles they have the capacity to make, according to a Bloomberg News analysis of just auto data. Sites shutting down would add to concerns that the region is facing a protracted downturn after falling behind competitors. And it's just a price illusion, because it looked from the outside as if the car making business and the car buying business was brisk and robust. Nominal prices and nominal revenues were soaring. And Volkswagen is a perfect example. Now they're talking about cutting back on production and closing plants for the first time in 87-year history. They're doing so because they got revenues without making as many cars. It was all a price illusion. To show you what I mean, look at Volkswagen's revenues over the past fiscal year, 2023. Their revenues totaled 322.3 billion euros, which is up 15.5% over 2022's 279.1. But compare both of those to the final pre-pandemic year, 2019. In 2019, Volkswagen's revenue was 252.6 billion. So revenue in 2023 was up almost 28% more than 2019, yet they weren't making as many cars because the prices went way up without volume recovering. It was a nominal illusion. And you think about what happened over the supply shock period. What happened was that governments gifted a windfall to the global big company sector. They borrowed money that was otherwise sitting idle during the lockdowns and redistributed it through consumers that ended up back at companies, big companies and their revenues and bottom lines. What did the big companies do with all that windfall money? Nothing. It just sat there. It went into financial assets. They didn't need to hire more workers or invest in more productive capacity because they didn't need them. They weren't making as many goods. The price illusion was that forced redistribution, inorganic, artificial forced redistribution through an economy that could not respond on the supply side. That's why we call it a supply side shock. So prices soared not for economic purposes or through organic and sustainable means. Prices soared as only a response to these two massive imbalances. There was no sustainable path forward from there. Again, as I keep saying, and this automaker problem in Europe is just the most extreme example. It's hardly isolated. It's all over the global economy. We see the difference between nominal values and in real terms and volume terms, the economy looks nothing like the nominal economy, or nothing like nominal prices made it look. It was all an illusion. And now as we go through this transformation, this transition, getting away from that price illusion, the supply shock, wearing off of all the artificiality that went with it, what's being left and what's being revealed is not the same economy. It's volume, not nominal. Back to the article here. Volkswagen AG threatening job cuts in Germany and warning it may shutter factories there for the first time is a reality check for Europe's anemic auto market that's set to face more closures. And it's not just the auto market, as I keep saying here. It's the price illusion that says the real economy is the volume economy, not the nominal economy. And as the nominal economy and all the artificiality wears off, nominal has to converge with real. We have to align revenues with what we actually produce, what we actually buy, what services we actually provide. It was okay and easy while nominal growth was happening, while revenues were soaring on price effects, because companies were cushioned. They could continue to hold as many workers as they had because they had revenues rising for that price effect. And they weren't hiring more workers or investing in productive capacity, which meant that at some point it all had to come crashing down. And we're getting closer to that same point. But transitioning doesn't happen all at once. It doesn't just fall right off a cliff. It's a process. And in this case, it's been a very prolonged and protracted process, but one that is the most visible out of anywhere in the world in Europe. Europe has been in a protracted, slow burn, low grade recession ever since the end of 2022, which was just a reflection of that start to the transition. They're going from the nominal supply shock where everything is nominally good to how do we get down to where volumes actually are? Is it all at once a big, huge crash? In this case, it doesn't appear to be. It's a prolonged process, prolonged and painful, and one that is impoverished and impacted workers and consumers and small businesses most of all. And that's why recession in the U.S. matters so much, because it proves that the global economy is suffering this transition, not something specific to just Europe or something specific to just China, like it's a real estate bubble. This is a globally synchronized transition from that artificial nominal price illusion a couple years ago to something very different, something that the bond markets have been telling you and warning you about this entire time. Speaking of bonds, over in Germany, the German bond market has made a huge move like we've seen all around the rest of the world. As mentioned, China's bond market, we won't get into that today. I'll talk about that in an upcoming video. There's a huge move in Chinese bonds, but also a similar move in German bonds and really the shots, the front end of the curve, just like in U.S. Treasuries. Germany's 2-year, big move since the start of September. It was yielding 2.39% on September 3rd. As of yesterday, it got down to 2.12. So in a little over a week, dropped about 27 basis points. It's backed off a little bit today with the ECB's rate cuts, down up to about 2.16. But from 2.39 to 2.16 in a little over a week. And it had been 2.6% as recently as the end of July. So the big global financial volatility and then everything else that's happened since then, confirming the troubling state of the global economy, the 2-year German has gone from 260 down to 216, and it was 308 all the way back on May 31st. So we've got a huge move in the front end of the German curve that has, for the first time, uninverted it. So we've got bull steepening going on in Germany as a reflection of everything I just told you about, this process, this recessionary process moving from nominal to real. As of today, you got the 210s that are uninverted. The 5-year, 10-year spread in Germany has steepened out. The 2-year, 30-year spread, that has steepened out tremendously as the German curve continues to reflect not just confirming what I've been saying about this transition, but also the immediacy of this transition. And that's where the ECB is today. The ECB announced another rate cut, even though consumer prices there remain substantially above the ECB's target, though the ECB's target, like the Fed's or any other central bank, is not really a target. They never hit it. But either way, that's how the ECB or policymakers around the world use to gauge their monetary policies. If consumer prices are above their target, then they think they need to be restrictive, except in this case. Even though the ECB said, especially 2022 and 2023, we're going to never rest until consumer prices are back down below our target, they now realize that the economic dangers all lie on the other side of the equation, on the employment side. What Volkswagen is saying is not just about Volkswagen, nor is it about automakers. Without that nominal price illusion, businesses have to take a hard look at their actual volume of production, of services, of everything. If you aren't using all of your capacity, then why have it? And what that means is closing down factories and laying off workers. Exactly what we've been talking about this entire time. As the ECB said in its official statement, financing conditions remain restrictive, though not because of interest rates. They just call them restrictive because of interest rates. That's just what their own jargon says. And economic activity is still subdued, which is understating the case. Europe has been in recession pretty constantly ever since the end of 2022, reflecting weak private consumption and investment. Weak private consumption because consumers have fallen so far behind with lost purchasing power and lost income power, and lack of investment because, as I keep saying, there's no need to invest because you've got all this capacity that never recovered. It was only prices. Back to the ECB. Staff project that the economy will grow by 0.8% in 2024, which they'll be lucky to get that, rising to 1.3% in 2025. They'll be even luckier to get that, and 1.5% in 2026. And even if those numbers are reached by the European economy, that's hardly anything like a recovery. This is a slight downward revision compared with the June projections, mainly owing to a weaker contribution from domestic demand over the next few quarters. And they also mentioned that their risks are tilted to the downside because of that weak domestic demand, as well as weakness overseas, in particular China, though now coming from the United States as well. So the European economy is not responding in the way that European officials had expected for this year. They had thought that after the stagnation of the last couple of years, Europe would start to gently accelerate, which is what they're projecting now, just pushing it further off into the future. And instead, they're realizing that consumers don't want to spend because consumers can't spend. Even though nominal wages are finally above prices for the first time in the supply shock period, that's only beginning to make up a very small part of the lost purchasing power because of how far behind all consumers are, all workers are, all over the world. As Eurostat reported last week, consumer spending in the second quarter of this year disappointed thoroughly. Here's what Bloomberg had to say about it. Despite lower consumer price gains and falling interest rates, as well as the twin boosts from Germany hosting the European Soccer Championships and France the Summer Olympics, spending is muted. Household consumption slipped by 0.1% in the second quarter, Eurostat said last week. In Germany, the biggest of the Euro area's 20 economies, it even dropped more strongly in the same period, and confidence among households has slid amid layoffs and corporate insolvencies. Volkswagen dealt a fresh blow last week, saying it may close plants in its home market for the first time in its 87-year history. Quote, "We expected consumption to make a contribution to growth in Germany, but this has not yet happened," according to Olaf Reuck, chief economist at the German Retail Federation. "Our hopes now lie in the second half of the year." And when he says that, he really means the ECB and rate cuts. And as we know, rate cuts are nothing more than a reflection of policymakers finally getting with the program here. Market rates go down, telling you what the economy is going to be doing, and eventually policymakers follow the market when they realize they were right. And in this case, we're not just talking about the short run lack of economic growth or recession prospects. We're talking as much about the long run, this bigger downside to the supply shock normalizing after a couple years of artificiality. And the OECD put out a report just last month that really highlights the trouble that we're in here. What I mean is that, as I mentioned at the beginning, real wages, when you adjust for prices, most of the developed world, let alone the developing world, which is where the Great Migration is coming from, but most of the developed world, still hasn't gotten even close to back to even with the pre-2020 levels when it comes to real wages. Around half of OECD countries are earning less now than they had before the pandemic. Considering hourly real wages, wages adjusted for inflation, consumer prices, people in the United States, Canada, Japan, Australia, and many European countries now have less money at their disposal than roughly 4 years ago. And that's something that just simply is devastating to any kind of economy, let alone an economy that's struggling with everything that has happened over the last 4 years. What it really says, what it really punctuates, is the artificial imbalances of the supply shock era. They crammed a bunch of money through the system just hoping that, as Keynesians, spending for the sake of spending would lead to a sustainable path toward economic growth and recovery, when all it did was distort a whole bunch of stuff in many very non-productive ways. A huge windfall to big companies, thank you very much, but not so much for everyone else. And that's the lost purchasing power that we keep talking about and coming back to. And what that means is the economy has to normalize to purchasing power. Not all that nominal stuff, that red hot economy and inflation everybody was talking about. We have to go where actual incomes and volumes are. And Volkswagen and European car makers are just the tip of the iceberg. And you can see exactly where this is going. It's going exactly where European officials wish it wasn't, but exactly where bond yields have been pointing. Europe is going to fall further back into recession because it never actually left. And the reason it never left is that this is a long-run process that is nowhere close to playing completely out. So the ECB rate cut today is European officials beginning to realize that Europe's economic problems the last couple of years were not as short run as the couple of years could be. There's still trouble in front of Europe. And so the ECB cutting rates is trying to stay ahead of that trouble when they're already way behind it, because it's not really about interest rates one way or the other. And it's not really about the short run either. It's about the supply shock, the price illusion, the recovery that everyone thought that we had and everyone said that we had over the last couple of years was all up here in nominal prices. And as those nominal prices increasingly disappear, we're left like Volkswagen looking at the real economy in volumes and thinking, uh-oh, we got to do something about it. And so the entire economic process needs to be rethought and repriced and everything from the ground up to renormalize to where volumes are, to where actual purchasing power and incomes are, and that is the bad news. That's what bonds have been saying this entire time. The message was ignored because prices and central banks. But now that central banks have to come back to where bonds are and where bonds are going, there's no more hiding the truth. We all got massively screwed the last several years, and we can no longer hide from it. I just briefly mentioned the Chinese bond rally, which took it up a notch again today, despite the fact that PBOC and authorities are doing everything they can to derail it. And I talked about all of that in a recent video. That's the one linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.